Did you get some stellar advice from an expert or a professional the last time you were negotiating your mortgage? Something along the lines of, oh yeah, rates are high now, but they're going to come down maybe next month, next quarter, next year, something along those lines. Are you regretting the decision that you made based on that advice? Watch this video to get no-nonsense insight that will help save you money in your next decision. Hi, and welcome to another episode of the Diligent Investor Digest, a channel that hopes to empower the everyday individual to make better investment decisions. In today's episode, we're diving deep into monetary policy, and we're taking a look at what we can expect from the Bank of Canada, not just in the upcoming meeting in the next couple of days, but also in the longer term. The first thing I want to draw your attention to is historic interest rates in Canada. Trading Economics has provided us with this lovely chart that goes back to just before 1991. And the main takeaway from this chart is that not so long ago, interest rates were very high, in the tens. We see here 12%, 13%, and so on. A lot of you may have heard stories from your parents about getting mortgages as high as 18%. This has happened before, and there's no guarantee that this will not happen again. Most of us, however, suffer from what we call a recency bias, which means that we only take into account the last 10 years or so of the past, and we expect that the future will be exactly like the last 10 years. And if we look at the 10-year chart, we can see that, yeah, interest rates were abnormally low for a very long period of time until March of 2022, they spiked up and we had the highest increase on record. So there's never been in history, there's never been a time when interest rates jumped up so high so quickly. Next up, let's take a look at an article from the Globe and Mail. The article is called Bank of Canada Expected to Hold Rates but Could Signal Policy Shift. Now, some of you reading this headline may feel like a bit of a Groundhog Day effect, where it's like, wait a minute, I'm sure I've seen that before. And you're absolutely correct. Basically, from the whole of 2023, all the talking heads and all the headlines were saying that, oh yes, rates increased, but we're gonna have, they're gonna come down. There was this perpetual expectation that interest rates were gonna come down in 6 months. And as time moved on, that expectation shifted 6 months. So it was this moving target that never goes away. And before we get into this article, I just want to remind you of some signals from the past coming from some of the major talking heads. So here is a video of Tiff Macklem famously telling Canadians in 2020 that interest rates are going to be low for a very long time.
Our overriding message to Canadians is that the bank will be there to provide monetary stimulus for an extended period to support the recovery and to return inflation to the 2% target. Interest rates are very low, and they're going to be there for a long time. We recognize that Canadian businesses are facing an unusual amount of uncertainty. And so we have been unusually clear about the future path for interest rates. If you've got a mortgage, or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time.
Low interest rates make spending and investment more affordable, and spending and investment will support the recovery. That would be our message to Canadians.
So obviously he's not completely wrong there. Yeah, lower rates do stimulate spending and investment, but we have not seen this promised low rates for a very long time. So let's go back to our historic rate chart. Here we have 2020. Here is July 2020. So interest rates just came down to 25%. This is when Tiff Macklem was warning everyone that they're going to stay lower for longer. Lo and behold, in a few months, well, maybe not a few months, okay, give it 2 years, we had the fastest increase of interest rates on record ever. And throughout this increase, everybody kept talking about a rate cut, right? Basically, all of 2023, the headlines kept talking about a rate cut. The rate cut never came. And while we're on the topic of signaling, here's another famous video by our Prime Minister also telling Canadians to basically start racking up the debt because interest rates are low.
Regardless of what that figure is exactly, future governments are going to have to carry that debt. The servicing costs on that are going to be very high.
Sorry?
The servicing costs on the debt that you're going to have to carry, that you're adding to now, right?
Interest rates are at historic lows, Glenn.
Okay, but it's still a lot of money.
No.
It's still a lot of money.
No.
And you don't know where. Okay, but how are you going to pay for that? How are you going to pay for those costs in future years? Are you going to increase taxes, or are you going to cut programs?
Okay. Right now, we're in an absolutely unprecedented.
Okay, so we now, this is 4 years later, we know exactly how to answer that question. The way he's going to deal with it is by raising taxes. Let's move on and get back to our article in the Globe and Mail. So what are the talking heads saying now? Central bank has held its policy rate at 5%, a two-decade high since July. But with the economy languishing and inflation back inside the bank's target range, many Bay Street economists and traders expect monetary policy to pivot in the coming months, perhaps as early as June. So again, they've been saying this for a really long time. The whole of 2023 was spent with the same kind of sentiment that like, oh yeah, rates went up, but like they need to come down. My advice to you is just ignore this as noise. Moving on. Financial markets put the odds of a rate cut this week at around 20%, so very surprising if we'll have a rate cut. This raises to more than 60% for a rate cut in June. And again, for the people that have been watching this is always the case. A few months out, there's always a target that rates are going to come down. But this expectation just never materializes. Bank of Canada is using high interest rates to slow the economy and reduce upward pressure on prices. They've been very effective at this. Not the upward pressure on prices, but the high interest rates have certainly slowed down the economy. There's a lot of statistics out there about, affordability and unemployment. We're in a crisis, so they're doing a good job there. Upward pressure on prices, I don't think they've been very successful. Unless you use the CPI index that they changed the formula to, then you can get statistics that look as if they're being successful. Mr. Macklem and his team have remained wary of bringing rates down too soon. Wary of bringing rates down too soon, especially considering the risk that real estate prices could surge as borrowing costs start to drop. So this is Mr. Macklem basically saving face. They really want you to think that the central bank is in control and they decide what happens to interest rates. And that's actually not true. Interest rates are decided by the larger market. It is the average of borrowers and lenders of money. That's who decides what interest rates should be. Now, the central bank is another market participant, and it is a huge market participant. So it can become a lender to stimulate the economy, or a borrower, depending on what the situation calls. However, it's important to realize that their powers are not infinite, and a lot of their powers were spent in the 2008 crisis. Many people don't know this, but the Bank of Canada has actually spent a lot of its ammunition. So it's not in a position right now to go against the market and start manipulating the market. It has no ammunition left. A lot of people don't know this, but the Bank of Canada is currently broke. They actually had to create special structures just to hide the losses in the Bank of Canada. This has happened for the first time ever, and it's happened under the leadership of Mr. Macklem. I think at this point it's important to point out that Mr. Macklem is a U of T academic. He has absolutely no real-life experience. As soon as he got some real-life experience, he's made a mess that we've never had before in history. And to summarize what I'm trying to tell you is the newspapers and the central bank are going to pretend as if they're in a position to control interest rates. And the reason why they're not lowering interest rates is because they see some danger, like the real estate market, or some sort of concern for the greater good. The reality is right now they're caught with their pants down and there's nothing they can do. They got to go for this ride of interest rates. And as interest rates go up in the larger global market, Bank of Canada has absolutely no choice but to follow. Continuing with the Globe and Mail article, we see here the Canadian economy is clearly struggling under the burden of high interest rates. Business insolvencies are up. Indicators of future sales are weak, according to a recent central bank survey of companies. Again, these are signs that usually, and if the bank was strong, they would be stepping in at this point to lower rates to try to stimulate the economy, to prevent business insolvencies, etc., etc. The latest employment numbers published by Statistic Canada on Friday showed an unexpected net decline of 2,200 jobs last month, while unemployment rate jumped to 6.1%, up from 5.8% in February. Unemployment has risen a full percentage point over the past year. Again, all these things are usually, and the reason why they write this in this article is because generally if things like this are happening, this is when the central bank would use monetary policy to try to steer the economy. At this point, they absolutely have no ammunition left to steer anything. So what does this mean to you? For example, if you're shopping for a mortgage, what do you do? Your financial professional is probably going to tell you to, get your 3-year variable mortgage and, bite the bullet for a couple of years until interest rates come down. I have been telling everybody to do pretty much the complete opposite. Going back to like the last 4 years, I've been telling people to lock in their mortgages. A lot of people don't know that you can actually get a mortgage for 10 or 15 years. So for everybody watching, it's very important for you to talk to your professional about terms that are as long as 10 or 15 years. And basically, hindsight is 2020. So if you were in 2021 or 2023 when interest rates went up, and let's say, okay, they went up to like 2.5%, which is pretty high, and you locked in that 2.5% for the next 10 years or the next 15 or 20 years, right now you'd be absolutely laughing. At this point, rates have gone up a little bit more. So it might be scary saying, hey, I'm locking in a really high rate, which is why it's important to note that historically, rates are still very, very low. And if things get out of hand, we could see interest rates as high as 10 or 15%. So maybe it's worthwhile to have that rock solid protection and have a fixed mortgage where your rate is guaranteed for the next 10 or 15 years. Now, I know for a fact that when you're sitting across from a mortgage broker or some other expert, and you talk to them about like a 10-year mortgage, they're going to basically give you the spiel of like, oh, what are you talking about? Don't worry about it. Take the 3-year variable. Interest rates have to come down. Look, the economy is suffering. They can't keep raising rates anymore, blah, 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 blah. I want to warn everybody, do not buy this half-baked analysis, if you can even call it that. Interest rates are going up. The main reason why interest rates are going up is because of risk. What am I talking about? If you look around the world right now, we have several wars going on. Nobody is talking about peace. Absolutely nobody wants peace. In fact, as soon as there's any peace deals to be made, Boris Johnson is deployed and he goes out there to make sure that there is no peace and wars keep carrying on. So as long as wars keep happening, that is what's going to keep driving risks up for investors or lenders. Basically, if tanks are rolling the street and there's heavy artillery and missiles flying around, that's not an environment where you feel secure lending your money. And if you are going to lend your money in that environment, you are going to ask for a higher interest rate. And that's exactly what's happening in the market right now. Risks are going up. Nobody is talking about peace, so I expect the risks just to continue to go up in the future. And therefore, you may very well see interest rates continue to climb up to the historic highs that are not unprecedented by definition. Now, please don't misunderstand me. I'm not telling you that you will never see a rate cut. As you can see, interest rates are pretty cyclical. They bob up and down. So, after the highest rate increase on record, yeah, it would be nice to see a little bit of a retracement, a couple of rate cuts. We haven't seen them now. Maybe we'll see them in the future. What I'm trying to tell you that in the long term, in the next 5, 10, 15 years looking out, interest rates are going to continue to go up. So you'd be wise to get some protection if you are in a position where you still have a mortgage and you're probably going to be paying off that mortgage for the next 10 years. Take advantage of the lower rates that we have right now to lock it in for a longer time.